Oh, thanks very much. I actually, you can hear that? Is that on? Okay. I actually went to high school in Littleton, so I'm from Colorado. This is before the Columbine shootouts, before there was a Columbine. We left in 1963. Okay, so I'm going to talk about the public option in banking, why we the people should own the banks. But I can tell just from talking before this event that you all are pretty far along in the public banking thing. So I'll just sort of go quickly through my first slides because you probably already know all this stuff, and then get to the real meat of how we can set up a bank and what we can do with it and that sort of thing. Okay. So globally, 25% of banks are publicly owned. It used to actually be 40% in the 90s, but it's gone down because of this wave of privatization. But still, that's 1 in 4 banks globally. So it's a very common concept virtually anywhere but here. And the largest banks globally are also state-owned, so that would include the 2 largest banks by market capitalization, which are in China, the largest bank by deposits, which is Japan Post Bank. They've actually privatized to some extent, but they still have a majority ownership. The largest bank by number of branches, which is in India, largest development bank, which is China Development Bank, and the world's 7 safest banks, leading with Germany's Public Development Bank, KfW. And it's also in these countries with strong public banking sectors that you have what are called economic miracles. China is the most obvious, and then Korea, Taiwan, Singapore, Hong Kong, post-war Germany and Japan, Brazil, Argentina. This chart, you can see the growth of China, how it's been exponential. The blue line is US, pretty good. It's growing, but you can see where China came up from nothing. It's just shooting up. That's that sort of orange area. And Korea is another phenomenal growth country. Per capita income increased 14-fold in 40 years, which is something that took Britain 2 centuries to do, and the US 1.5 centuries to do. So this is from a book by Ha-Joon Chang, who is a Korean, or is an economist from Korea. The book is called Bad Samaritans, and he says in this book that it's a myth that the reason Korea has done so well is because it's gone capitalist, that it was actually what they did was retain public ownership of the banks. The Japanese figured that out. The Japanese model was that in India, it was called the commanding heights, and you owned all the public infrastructure. But in Japan, they figured out you didn't need to own anything but the banks. If you owned the banks, you could control development, you could control where the credit went and how much credit was out there, et cetera. So he said the secret of Korea's growth was the government owned all the banks so it could direct the lifeblood of business, which is credit. So in the US, we have one state-owned depository bank, and that's the Bank of North Dakota. North Dakota is also the only state that escaped the credit crisis. It's got the lowest unemployment rate in the country, the lowest default rate on credit card and student debt, and one of the lowest foreclosure rates in the country. So it looks like socialism, but in fact, North Dakota is a very conservative Republican state. So for them, it's all about state sovereignty, keep bringing our money back into North Dakota, in their case, to be used for the benefit of North Dakotans. It was set up nearly 100 years ago when the farmers were suffering from a major depression, and they were losing their farms to the out-of-state bankers. So they formed a political party called the Nonpartisan League, which I thought was a great title, and they won an election and set up the Bank of North Dakota. And it's done remarkable things in the last century. It did struggle in the beginning, as any new thing would, but in particularly the last 20 years, it's done remarkable things. So the model was that by law, all of the state's revenues are deposited in the bank, and then they have that huge deposit base, which they can then leverage into credit for the state. And unlike private banks, they have a mandate to serve the public interest. So they have certain sectors that they support. These are agriculture, energy, education, and home ownership. And they make, for example, 1% loans to startup businesses and startup farmers and very low interest student loans. And in the last over a decade, they've had a return on equity of between 17 and 26%. And they were returning a $40 million dividend annually to the state, but in the last couple of years, they've expanded so much that they have kept that capital for purposes of leveraging more credit, so they've kept it in the bank. But anyway, that's $40 million on average of profits, which is a lot considering that they're a country of a state of 670,000 people, which is very small. California has 50 times that many people. I'm from California, so you can imagine, or I'm now from California, so you can imagine the possibilities in California. So in 2014, the Wall Street Journal came out with an article that said that the Bank of North Dakota was actually more profitable than JP Morgan Chase or Goldman Sachs. It had a return on equity of 18.56%, which is about 70% higher than Goldman Sachs and JP Morgan. That article attributed their success to oil, and at the time I wrote an article refuting that based on this chart. This was oil growth. You can see that the oil boom didn't really take off until 2010, and they were already the only state to escape the credit crisis in early 2009. But particularly in the last 2 years, you can see it's not all about oil because they've had an oil bust for the last 2 years, and yet in December of 2015, they reported the highest profits ever. I mean, every year in the last decade, they've reported higher profits than the year before. So they're going like gangbusters despite the fact that they're dealing with an oil crisis now. Excuse me. So the real reason is, we would argue, that it's their business model. Their business model is more efficient, and in fact, there are studies showing that public banks are globally more efficient and more profitable and actually safer than private banks overall. So the one reason they're more profitable is they don't have bonuses, fees, or commissions. They don't have high-paid CEOs. I think the highest paid is the president, who last time I looked was making something like $275,000 a year, compared to Wells Fargo, for example, where the president is earning over $20 million a year. Yeah, so they don't have shareholders who are claiming dividends. The dividend goes back to the state, or it goes into the capital base of the bank. They don't need to advertise because they have a built-in deposit base with all the state's revenues. And they don't have to seek borrowers because they partner with the local banks, and it's the local bank that goes out and does the initial groundwork, finds the borrowers, determines creditworthiness, sets up the loan. Then the Bank of North Dakota just comes in and helps with liquidity and helps with capitalization. So they buy down the loan, or they participate in the loan. So they're really more like a money center bank or a banker's bank than a retail bank. And for that reason too, they don't need to have a lot of branches. They've now built a new branch, so they actually have 2 instead of 1, but they don't really cater to individuals. Like only about 3% of their depositors are individuals. All the rest is the state. They don't need ATMs. And it's not just the Bank of North Dakota that has this stellar sort of performance. The Sparkassen banks in Germany also in 2015 reported that they were more profitable than the local private retail banks. And the Sparkassen are the local public banks in Germany. So they're in communities. They're small, and they do ordinary, old-fashioned banking. This is to distinguish them from the Landesbanken, which are also publicly owned, but they're very big, and they were pressured into getting into speculation. So they have not done so well. But the Sparkassen banks have done really well. And you can see from this chart, the orange is the Sparkassen banks. Then the baby blue is the private retail banks, and they actually did pretty well before the crisis, but then they plunged. So you can see that overall the orange has done much better, and then the green is also doing quite well, and those are the credit unions. In the U.S., we have 23 states that have brought bills of one sort or another for publicly owned banks. This chart is a bit old, it's leaving out a couple of them. And then we also have a number of municipalities that are in active pursuit. Santa Fe, for example, just yesterday brought a resolution before their local governing authority. I'm not sure what it was. Anyway, for a publicly owned bank, and they've gotten quite far with it. They've done a feasibility study, so they're really moving on it. And then you can see these other places. I'll be speaking in Sonoma in a couple of weeks on setting up a publicly owned bank, Philadelphia, Pittsburgh, etc. But we haven't managed to get any of these bills passed, and we have been working on it since 2011, or the Public Banking Institute was set up in early 2011. So the question is why? One reason, of course, is we're up against these big bank lobbyists who can always outgun us at hearings. But more fundamentally, I would argue, there's a misconception about how banking works, where our money comes from, what kind of risks you're taking with a public bank versus a private bank, how a private bank's set up, et cetera. It's just, so we need a broader understanding of our whole financial system, and that's what I do, is I write and speak and try to shed light on all this. So one argument you'll hear is, we don't trust government. You know, you want more government, you want to give your money to the government, but here's the thing, it's the government's money. The question, and we are the government, we should be the government, and if we want to get the power back, we need to get the money power back. And in the Bank of North Dakota, we did have one retired Bank of North Dakota man who has now passed away, unfortunately, but he was on our advisory board. And he said, we are not politicians, we are not a development bank, we're not there to support businesses that can't otherwise get loans. We do old-fashioned banking, very conservative banking, and we are not influenced by the politicians. You know, they're not into cronyism. Then there's a question of risk, which I'll get to, but here's my favorite, because it's that you periodically hear legislators say, we can't afford to lend our deposits or our revenues because we need that money for our budget. So this assumes that banks actually lend their deposits. And money reformers have been saying for decades that that's not true, but finally, the Bank of England made it official. So in the spring of 2014, they came out with in their quarterly report, they came out with an article which said that, contrary to popular belief, banks do not lend their deposits. They actually, so they said banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. So, and then they went on to say that 97% of the UK money supply is created in this way. So our money is being continually created and continually destroyed by banks all across the country. Every time they make a loan, they are creating money. Every time a loan is paid off, money is extinguished. So it's not like the old-fashioned view of money being a stable thing that's out there and you have to get it from somewhere else. Or, you know, there's only so much that the government can spend, for example, and you have to get that from somewhere. You have to borrow it from someone else. In fact, money is created when loans are issued. And you can see that from this chart of the U.S. money supply. The orange line is M2, that's the circulating money supply. The blue line is currency, so that's coins and dollar bills. You can see that that's a very small part of the money supply. And you could argue that the dollar bills aren't even issued by the government. I mean, the Federal Reserve is composed of 12 branches, all of which are 100% owned by the banks in their district, the private banks in their district. And the federal, if it were the government just issuing money, like they do with coins, they actually do issue the coins. The Constitution says Congress shall have the power to coin money and regulate the value thereof, and that's what they do. They issue coins. At one time, that was actually 50% of the money supply. But now it's minuscule, and when the American colonists actually issued their own money as paper scrip, they issued it and spent it. You know, it was their money, they issued it and spent it on goods and services needed by the government. But when the Federal Reserve issues paper dollar bills, they lend it or sell it. So the government has to borrow those paper dollar bills just like everyone else, or the banks will buy them and then give them to people as needed. But it's always borrowed into existence, just like the deposits, which make up the vast majority of the money supply. So they do it by double entry bookkeeping. So if you go to the bank to take out a loan, say for a house, you take out a $100,000 loan, they will write that as an asset to them, an asset on one side of their books, which is you're going to pay them back over time plus interest. And then they'll write it as a liability to themselves on the other side of their books, because your seller who gets your check is probably going to deposit it in another bank, and so the first bank will have to cover that check. So from their point of view, they've got a $100,000 liability, a $100,000 asset, so the books balance and all is well. But that $100,000 check that goes into another bank will be counted as a new deposit in that other bank, so that's actually new money. And let's say, so this is happening all over the country. Nobody worries about balancing the books till the end of the day. So all the day long you have checks going in and coming out. And ideally, let's say Bank B also created a $100,000 loan, and that check wound up in Bank A. So you would have both banks with $100,000 going out, $100,000 coming in, their books balance, it all looks good. But in the whole system, $200,000 was just created out of thin air. And if they don't get the $100,000 in, if they don't manage to get enough deposits to balance out what the liabilities that just left the bank, then they can borrow. And they can borrow very cheaply, either from other banks at the Fed funds rate, which is currently 0.4%, or on the money market, which is even cheaper. I won't try to get into that, it's quite complicated. But so let's say at 0.4%, that's the perk we want. We want to be able to borrow at 0.4% instead of at 5% or whatever the bond rate is. And that's what we could do by leveraging our own deposits and our own capital. And notice they just borrow that overnight. So it's really a sort of fraud, and that is where we get in trouble. That's what caused the 2008 crisis, was that overnight market froze. So you borrow, you come up short, you borrow just for the night, you give it back the next day. Quite often it's the repo market where you give them some securities and they give you the cash, and then you give it back in the morning. But if for some reason that market freezes, as happened in 2008, then the whole system collapses. So it's actually a very unstable system. But if we're borrowing from ourselves, but I'll get to that. So we can we can do that in a stable way. So what's wrong with this model? First of all, the growth imperative. They don't lend money. I mean, when they do lend money, they expect to get more back than they put out there. And they typically get, like on a 30-year loan, they get at least twice as much back as they put out. This is called the debt virus theory, and I've gotten into loads of trouble on it. But, it's just anyone can see. I mean, the argument is that, well, there's the velocity of money, and you can pay that from something else, and overall you can manage to pay off the loan. Okay, but just, common sense tells you that if everybody is borrowing on 30-year loans and paying back twice as much as they borrowed, there's going to be a debt overhang. You're going to have to take out more loans in order to cover that debt. And in fact, debt does grow. exponentially, and productivity grows linearly. So you've always got this debt overhang that eventually crashes. Exponential growth is found in nature, in cancers and parasites, and in compound interest. So when the parasite runs out of its food source, then it hits the wall and the whole colony dies. The whole thing collapses. So that's the same thing that happens when you run out of debtors. Then you're going to have one of these business cycle crises where everything collapses. So we've had that for 200 years, where you have booms and busts and booms and busts because of a faulty business model. Another problem is control. The private bankers determine where the money goes, who gets it. They can give it to their cronies. They actually can lend it to themselves through the repo market, which is it's difficult, so I won't try to explain it. But anyway, they have managed they're buying up the planet, basically, using this ability to leverage. And since the repeal of Glass-Steagall, they can do basically what they want with this money, within certain limits, but mostly they can do what they want with it, including speculate, derivatives, etc. In fact, when you put your money in the bank, it does not belong to you anymore. It belongs to the bank. It becomes their property, and you just are a creditor. You have an IOU. And they can refuse to lend, which means they can shrink the money supply. So there's just not enough money out there to run a thriving economy. Then there's a question of risk. This is a risk that legislators don't recognize. All governments have more than $250,000, so they're not covered by, or most of their money is not covered by deposit insurance. But they think they're covered because they're collateralized, that any bank that holds government deposits has to hold that much or more in collateral. But the problem is that the same collateral goes to the derivatives in the repo market, and they're liable to take it all in the event of a bail-in. So we had either we're paying as taxpayers in bailouts, which happened in 2008, pretty much globally, 2009. And then in 2010, the government said, no more, we're not going to bail out banks anymore. And the new plan was called bail-ins. So they would be turning creditors' money into capital. So this is the law now. It was made official in 2014 when the G20 met in Brisbane, Australia. So by law, if a big bank, one of the too big to fail banks, fails, they are to actually take the money of their creditors and turn it into capital for the bank. So you, the creditor, the largest class of creditor of any bank is the depositors. So you, the depositor, creditor, will have a share of stock in the bank. You are covered up to $250,000 by FDIC insurance, theoretically. And this is an old chart. So the little blue line is the FDIC fund. The green block is so that currently it has $74 billion in it. The green block is the deposits that in the country, so it's close to $10 trillion. About half of that is covered by FDIC insurance, like under $250,000. And then the orange block, that's the threat. Those are the derivatives and the derivative exposure of U.S. banks, which on this chart goes pretty close to 300 trillion. Currently, I think it's at 246 trillion. But anyway, it's a big risk. And by law, when a bank goes bankrupt, the derivatives and the repo market goes first in a bankruptcy. So they get the collateral, and these are both basically banks betting against each other. So the big banks get the money, and whatever is left over may or may not go to the FDIC. But the problem is, so we have all these problems with our current system, but we need the credit. We need banker-generated credit. There would not be nearly enough if we limited ourselves to coins and paper dollar bills or gold or whatever else of a limited commodity that you wanted to use. So this idea of banker-created credit has gotten us very far, actually, in the last, say, 300 years. In fact, supposedly, I read somewhere that Napoleon refused to do fractional reserve lending, and he only wanted to use gold. And the British were doing fractional reserve lending, which meant they were creating credit out of thin air. And on this credit that they created out of thin air, they managed to beat Napoleon. And you could say the same thing about the American colonists, that they were creating money out of thin air in the Continental, which did go to zero by the end of the Revolutionary War. But they won the war against the British, who were, a very powerful, the very powerful mother country. So how can we get back the power to create money? In 1787, the states gave up that power. Before that, they were issuing their own paper scrip. So in 1787, they delegated that to the federal government, but then the federal government was afraid to take it because the Continental had collapsed, and so they were afraid to put in the Constitution that they had the power to create paper money. The Constitution just says Congress shall have the power to coin money. Some authorities read that as including paper money. But anyway, it left all that sort of in limbo, so that the private banks then came in and printed their paper banknotes, which a banknote is a promissory note, but it actually had the name of the bank, and it was actually a private promissory note for gold in the 19th century. But of course, they issued many more notes than they had gold, and that was the beginning of this fractional reserve system where they created money out of nothing. Then when the National Bank Act came in 1864, 1865, the idea was to try to get all the banks to become part of the national banking system. But the local banks that didn't want to do that, instead of paying this, so there was a 10% tax on issuing your own paper notes. So instead of paying the 10% tax, that's when they started this whole deposit account idea, where they would issue money just by writing it into your deposit account, and then you could write checks on it. So they didn't have to pay a tax on this money, but they were still issuing it in the form of deposits. So how can we get that power back? We can do the same thing. We can set up a bank, leverage our own funds into credit for the community. The original model was in Pennsylvania during Benjamin Franklin's time, although he didn't actually create it. It was the Quakers that set it up. The other colonies were issuing paper money, which were supposedly an advance against taxes. So this is what gave the money its value, that it would be that you would collect it again in taxes. It was good for the payment of taxes. But it was a lot harder in colonial times, frontier times, to get the money back than to put it out there. So the northern colonies did tend to devalue their currency by printing too much. But in Pennsylvania, they came out with a system where the government owned a bank, the colonial government. So then they would make loans to the farmers. So they could, for example, print 105 units, whatever they were called, and lend 100 at 5% interest, which was considered a good interest rate then. It was much cheaper than the Bank of England, and the Bank of England wasn't even around. I mean, they just didn't really have a credit system. And then print another $5 and spend that in the community. So you'd have $105 out there circulating, which could all come back as principal and interest. So you could lend the same 100, spend the same 5. You could do that over and over, and it was a completely sustainable system. So during the time that system was in place, they paid no taxes except an excise tax on liquor, which was considered sort of a penalty tax. They had no inflation as a result of money printing. There was a bit of inflation when they had shortages, and they had no government debt. So it was a totally sustainable system until King George forbade the colonies to issue their own money, which some people say led to the American Revolution. It created a depression. They didn't have money anymore, so they started printing their own money anyway, and this was considered an act of rebellion, which led to the revolution. So here's what I know here you're talking about what you could do with your limited amount of funds. I guess in California, it takes $20 million to form a bank, and I understand that that's about the same here. Or did you say 25 billion? What's that? Or million, I'm sorry. 20 million to form a bank.
I think it's less, like 5 million just to do it.
Okay, yeah, I wondered about that. Okay, but these are California figures. So let's say you get the money from the pension funds for your capital. So they're always looking for a good investment. California has $500 billion in the pension funds. So to pull $20 million would not even be missed. And they like to get 7% interest. They're not getting 7% at the moment. But let's say, fine, we'll give you a 7% dividend on your money. So that's an annual cost of capital of $1.4 million. Then this would allow you to, at a 10% capital requirement, you could pull $200 million out of JP Morgan or wherever your money is right now. If you have that in revenues, which I assume, tax receipts and stuff, I assume would be available. So pull that money out, put it in the bank as your deposit base, the way the Bank of North Dakota does. And a good return for that sort of money right now is 0.5%. So let's say you pay them 0.5% interest. So your cost of funds would be $1 million for deposits plus 1.4 million cost of capital, 2.4 million. This would allow you to give you, if you pull out 10% of your 200 million for the reserve, 10% reserve requirement, this would leave 180 million that you can lend or invest. So let's say you did the simple thing and took that 180 million and bought municipal bonds with it, paying 3%. This could be done by one guy in an office. So, if you're doing this simple sort of single transaction deal. So you buy 180 million in bonds at 3%. So you're going to make $5.4 million on those bonds. And your cost of funds is 2.4 million. This is annually. So your net profit annually is $3 million or 15% that's return on equity. And that's not counting the 7% that you're going to pay to the pension funds. You're already taking that out. So that's a very nice return. It's just free money, basically. And I've heard bankers say that it is free money, that it actually is a license to print money, and it's something that we should be doing ourselves. Or let's say you're a little nervous about lending of the full 90% and you want to hold back 30% in reserve, which is what small banks typically do. So you run those numbers again, you still got a $1.8 million profit after you paid the pension funds, or 9%. Or this is what I just suggested in an article. In California, we have a bond issue, Proposition 51, a bond measure, Proposition 51, which it's backed by developers, of course, and they're suggesting a $9 billion bond issue to be paid back over 35 years at 5% for building schools. And we do need the schools. And for that reason, you find teachers, et cetera, supporting it. But there's a cheaper way you could do it. Let's say you took $1 billion out of our $500 billion in pension funds. So this is public money, public pension funds. And use that for your capital base. So at 7%, the cost of capital would be $70 million annually. Then you pull $10 billion out of, in California, we have a treasurer's investment pool, which is all the monies managed by the treasurer from various agencies, local governments, et cetera, that give him their it's sort of like a rainy day fund, the excess funds, to manage as an investment. So that currently has about $70 billion in it. So if you just pull 10 of that $70 billion out, it's currently earning 0.6% interest. So fine, we'll give them 0.6% interest on that money. So they're not going to lose anything. They're basically moving it from CDs in some other bank into our bank. So your cost of funds is going to be $60 million annually, and our cost of deposits $60 million annually plus 70. So $130 million annually is your cost of funds. If you multiply that out by 35 years, your cost of funds is $4.55 billion. If you multiply out what the bond issue would be, it's $15.75 billion in interest over 35 years. So you're saving $11.2 billion by doing it, by just leveraging the money yourself. And if you then, at the end of 35 years, pay back the $1 billion to the pension fund that you took originally as capital, you've got a $10 billion profit on a $9 billion bond issue, or you've saved $10 billion on a $9 billion bond issue. So that's that's something you could do with one guy sitting in an office, assuming, we could call it an infrastructure bank, and we can say we're not getting into subprime lending or anything risky, and it's going to take a lot of personnel. We're doing infrastructure for ourselves. We just want to leverage our own funds into money for infrastructure. You could do that with a very, very low overhead for the bank itself. So on average, it's calculated that 50% of the cost of infrastructure is financing. So that would be interest and fees. These are two examples from California. The Bay Bridge retrofit was $6 billion was the principal, and by the time it's paid off, it'll be another $6 billion in interest. And that's also true for the initial outlay on the bullet train approved by the voters, which was close to $10 billion, and it'll be close to $10 billion in interest. So you could save all that in interest, basically, or save a good portion of that in interest by running it through your own bank. There's always a question. People always say, how do you avoid corruption? I don't trust politicians. First of all, you can bake that into your enabling legislation. Have limits on what you can use this money for. Don't allow speculation and so forth. No bonuses, fees, commissions. So there's no incentive to churn loans or to make loans that aren't good loans just because you're getting some sort of fee out of it. You're just dealing with civil servants. I did a presentation in Iceland with a man from the Sparkassen group in Germany, and he said, when we hire bankers, we don't hire them from the retail. We don't hire retail bankers. We start fresh with young men out of college or young people out of fresh minds, because it's a totally different mindset. You're thinking like a civil servant, serving your local community. You're not thinking in terms of how much money can I squeeze out of this and what can I get away with and what can I make for myself. So, and then you want full accountability and full transparency. The Bank of North Dakota is audited 3 different ways, I think. And for transparency, this has always been a problem in banking because it's so complex. Nobody can tell what's going on. The regulators can't tell what's going on. There's all these things hidden behind, off balance sheet things. But there is new financial technology coming online, which I think is pretty exciting. It's blockchain, which is the software that they use for Bitcoin, which is a private currency, which was a private digital currency, which is billed as you can do it out without bankers and without government. So that could be used with your, you could do a digital type currency using blockchain. I've just been writing quite a bit about this, but that's a whole different subject. But anyway, there is, in the future, I can envision a system where we are basically acknowledging that all money is just credit, that when you take out a loan, you're basically turning your own credit into money. You're not borrowing that from someone else who had the money. Your credit is something that we create ourselves, and all the checks and balances that are currently in the system, all the middleman functions, could be done by this computer program that it bakes these contract terms right into the program, and it actually enforces the terms. So this is a quote I liked from, it's an online blog called Digital Donut. It was an article on the blockchain revolution. He said, blockchain eliminates the need for clearinghouse entities of any kind. And that means a revolution is coming, a fundamental sea change in the way we do business. So I think in the future, we can iron out all these problems that we've had before with corruption in government, corruption in banking, et cetera, due to advances in technology. But of course, we're going to need the enabling legislation to get us from here to there. So that's my basic presentation. For more information, publicbankinginstitute.org or my blog at ellenbrown.com has over 300 articles on it. And my 2 books, Public Bank Solution and Web of Debt.
Yes.
Thank you.